Let's zero in a little bit on the commodities, which have been flashing some warning signals of their own lately. So far in April, aluminum is down around 4%, gold up 2%, Bitcoin surging 6%. We've talked about that one. What is this? Is it a classic recession trade? Let's take a look with Carter Worth. He's the founder and CEO of Worth Charting and joins me now. Carter, it's good to see you again. Welcome.
Likewise.
What do you divine? Go ahead.
Yeah. Well, I mean, so many moving parts, and it's ever thus, right? Things that are dormant come to life, Bitcoin, and things that are loved are all of a sudden not loved. We know in the beginning of the year, the most popular, embraced area of the market was financials and banks. Too bad. We know that tech was hated. Look at that, right. Off to the races. And it is always that circumstance. The net effect, though, of course, is the market is churning. It's not progressing, and we are at a major inflection point. It's usually fundamentals that come along and inform the pattern that is the market. And of course, it will be earnings. We shall see. My bias remains that there's little to no upside, while unknown, but perspective, lots of downside.
I remember when we talked in December about your concern for the S&P 500. And again, now we've seen this big liftoff, at least for the NASDAQ, since January 1. Just before you joined me here today, you put out another note again saying, look out below, grab your hard hats, S&P 500. So why do you continue to look at these formations and say they are telling you there's more downside than upside?
Sure. Well, so remember, the weak form of analysis, if you will, is to stare at the chart of the S&P. It's really the principle that the parts compose the whole comprises the parts. So we try to study the parts as any good fundamental analyst would do. We look at the charts one at a time. And we obviously have a very bifurcated market. We know that we have tech and telecommunications up 20+% for the year, while you've got financials down 6-7. And one could say, well, okay, that's what rotation is. But the problem is that when we put out a note about a week and a half ago, it's the face of fear. Is it good technique when one is concerned about prospective weakness in the economy to move into large idiosyncratic growth names? It is good technique, right? Because they're defensive by nature. But it's almost to the point of hysteria. The move into Apple and Microsoft in particular, they're such big, mature names. It's almost like this. It's saying, I am so worried, I'm so concerned, let me just give all my money to John Rockefeller and Andrew Carnegie, which is to say, here, Bill Gates and Steve Jobs, I know Jobs is not with us. You have my money. I think it's the safest place to be. I don't think that's a particularly bullish thing. To me, it's right, hiding, it's defensive.
The only thing I would say in conjunction with that is look at Tesla, look at DraftKings, right? Look at some of the most speculative stocks. I don't know if Tesla's that speculative, but, there we saw other kind of high multiple tech trade higher, and not just big cap tech. Maybe just a comment on that, because I'm curious how much more upside you think there is in Bitcoin and gold and all the rest of it. So I guess the larger thing we're trying to trace out here is, do you stick with what's been working or not? And all these things feel like they're working together, but actually the correlation between crypto and the NASDAQ has broken down significantly this year. So we're trying to figure out what the next leg is.
Yes, I mean, good technique in principle. Momentum's a powerful force, just to the downside as is to the upside, and you want to generally respect it, unless and until it gets to be the definition of a crowded trade. And I think that's the circumstance you have. And remember this, the S&P 500 technology sector is right now trying to finally recoup all of its relative losses since the dot-com peak. So if you simply look at an RS line of the tech sector, as constructed by Standard & Poor's, it is yet to recoup all of its losses relative to the S&P since March of 2000. It's awfully close. It just shows how bad it is if you buy something at the wrong moment. But as to Bitcoin, there's so many ways to look at it. This is obviously the most volatile thing there is. So it's up 100%, 15,000 to 30,000. One could say that's quite bullish. Another way to interpret is Bitcoin, recently down as much as 77% from its all-time high, is now down only 56%.
Right. And so in other words, you're still bearish on Bitcoin.
Yeah, it's come a long way. If you've got gains, I would book them.
So what Bitcoin you see downside, S&P 500 you see downside. How much downside, by the way?
Well, you have to assume it's not, talking about, and you see this sometimes in reports, we think the market can drop 3% here or rally another 4%. Really? Who cares? I mean, it's got to be something meaningful. So I think you've got 8 and 10% downside at a minimum. Whereas gold, I think it's the place to be.
Okay, so final question then. We've finally seen some high yield inflows. First time, I think, in the past 7 weeks, largest inflows this year, seen as another of these kind of classic signs of risk taking, maybe, corroborates the kinds of things we've been talking about in tech and all the rest of it. Is this a signal that you put a lot of credence into?
Well, what's interesting, if you look at an overlay, and you can do it between a high grade investment quality ETF like LQD versus junk, they're trading almost, there it is on the screen, they're almost identical.